So trading on margin, or trading with borrowed money essentially, can be a very powerful tool in the world of stock trading, but it can also be extremely dangerous if you don't fully understand how it works or if you don't use it correctly. And so that is going to be the focus of today's video. I'm going to carefully walk you through some detailed examples that will illustrate exactly how trading on margin works. And also through those examples, I will discuss the benefits and also the risks that are involved. Now, as always, before we fully dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, so now before I walk you through some very detailed examples that again will illustrate how trading on margin works, you do first need to understand a few concepts about trading on margin. Now, as I mentioned at the beginning of this video, when you trade on margin, you are essentially borrowing money or stock, depending on whether you are buying stock or shorting stock, but you are still borrowing something from your broker and using that to trade stock in the market. Now, this video here is going to focus mostly on buying on margin, basically using borrowed money from your broker to purchase shares of stock. I will perhaps make a separate video talking about short selling in particular, but still, whether you are buying stock on margin or short selling stock on margin, the concepts discussed in this video are going to be applicable to both. And so the first concept you must understand is, what the heck is margin? Well, margin is essentially the collateral that you, the trader, have to put up in your own account to cover the credit risk that you pose to your broker. Now, why do you pose any credit risk to your broker? Well, because you are literally borrowing money from them and using that money combined with your own capital, that's your collateral, to purchase shares of stock. So you are quite literally taking out a loan from your broker, and therefore there's always a possibility that you may not pay it back. So that is risk to your broker, and that's why they require you to put up margin, some of your own capital combined with the borrowed money, to actually start trading stock. Now, what do you need to do to be eligible to open a margin account with your broker? Well, it's actually very simple. All you have to do is specify that you do indeed want to open a margin account, and then you must deposit at least $2,000 into that account. Now, keep in mind that is also the industry-wide minimum, $2,000, but your broker can require more. So please do check with your broker and see what their specific minimum is to be eligible for margin. And then also, as a side note, if you do want to be able to sell naked options, you must, one, have a margin account, and then also the industry-wide minimum deposit you must make into that account is $5,000. But again, check with your broker to see what their specific minimum is. So at this point, once your account is fully open and operational, you can now borrow up to 50% of the full purchase price of any stock that you want to buy. So for example, if you wanted to buy $10,000 worth of stock, but your account only has $5,000 in it, doesn't matter. You can still buy the stock because 50% of the $10,000 is $5,000. So therefore, you can put up your $5,000 and then borrow $5,000 from your broker, and boom, you now have $10,000 that you can use to purchase the stock. And the same concept applies to short selling too. So again, if you wanted to instead short sell $10,000 worth of stock, then you still have to put up at minimum your $5,000 of capital, and then now you are eligible to borrow the full $10,000 worth of stock and sell that in the market immediately. So basically, the main benefit of trading on margin is you can now trade much larger position sizes with smaller amounts of your own capital. And therefore, as you will see in this video, this has the effect of magnifying your profits or your losses. And so that's where the main risk lies. Your losses could be much bigger than you might expect. Now, also one point I do want to clarify here is that you will only actually begin borrowing money from your broker to purchase stock when you actually need to. So again, if you wanted to buy $10,000 worth of stock, but your account already has $10,000 in it, then fine. You can use all of your own capital to buy that stock and not borrow a penny from your broker. So basically, it's only when you go beyond your own capital limits, at that point, you will start borrowing money from your broker. Now, do also keep in mind that when you do start borrowing anything from your broker, whether it's cash to buy stock or the stock itself to short sell it, once you start borrowing from your broker, you will be charged interest on that borrowed capital on a monthly basis. And every broker can charge different interest rates for differing amounts of capital that you are borrowing from them. So definitely check with your broker to see what their interest rate structure is like. But one commonality that you will find across pretty much all brokers, as you can see here with TD Ameritrade's interest rates, is that the more capital that you do borrow from your broker, the less and less the interest rate will be. And again, keep in mind the interest that you are accruing will get posted to your account typically on a monthly basis. Next up, we have the concept of maintenance margin. Now, what is this? Well, simply stated, maintenance margin is the minimum account balance or the minimum amount of equity that you must have in your account at all times. And if your account balance drops below that point, for example, if you buy stock on margin and the stock price starts to go down, eventually you will get what's called a margin call. And a margin call is simply an urgent notification from your broker saying that you must deposit more capital into your account or liquidate existing positions to free up capital as soon as possible. Typically, you'll have a few days to do this, but if you fail to do it on your own, then your broker now has the right to step into your account and liquidate positions at will. Basically, the whole point of this is your broker wants to make sure that you always have the ability to pay off the loan, either return the cash that you borrowed or return the stock that you borrowed. And just for your reference, the industry-wide maintenance margin is 25% of the notional value of the positions that you have on. And again, I'll explain what all this means in detail through my examples in a moment. Now, that being said, that is also the industry-wide minimum. That's what your broker has to require at least for maintenance margin. But again, your broker can require more than that if they see fit. So for instance, if you trade with TD Ameritrade like I do, then they actually require 30% as your maintenance margin. Okay, so now that I've thoroughly confused all of you, now we're going to jump on over to my computer and I'll walk you through some very detailed examples that will illustrate how all these concepts come together. And by the end of it, you'll know exactly how margin works. Okay, so now I'm going to use this spreadsheet here to carefully walk you through a few detailed examples so that you can fully understand how all these concepts work together. And so for all four of these examples, all four of these scenarios basically, we're going to assume that you open a margin account and your starting account balance is $5,000. Okay, that's the initial amount of capital that you put up that you deposit into your account. And so once that's done, you go into your trading platform and then you come across this stock ABC. Of course, this is a made-up ticker symbol, but just for the sake of example, let's say you come across this stock and for whatever reason, you are really bullish on this underlying. And so as a result, you want to buy 100 shares of ABC stock. Now the current price of the stock, however, is $100 per share. So therefore, if you wanted to buy 100 shares of this stock, the notional value of that position, or basically the full amount of capital that you would need to put up to buy those shares would be $10,000, right? You basically just take 100 and multiply it by 100. But of course, right now your account only has $5,000 in it, right? However, again, because you opened a margin account, you can borrow up to 50% of the full notional value required to put on the position. So 50% of $10,000 is equal to $5,000, right? And there we go. You can now borrow $5,000 from your broker, and then alongside your own $5,000, those two things together equal the 10 grand that you need to buy those 100 shares. Now, also before I continue here, just to make things a bit more clear, you do not have to always borrow the 50%. You can definitely borrow less money to put on a smaller position. So for example, if instead of buying 100 shares of this stock, let's say I wanted to buy only 80 shares, well, in that case, 80 times $100 per share, the notional value of that position would be only $8,000. So therefore, you would put up your 5 grand, and then you would only have to borrow $3,000 from your broker. So again, just wanted to make that clear. Okay, so now moving on to the equity section. Your equity is essentially the percentage of ownership that you have in the full position, right? So conceptually speaking, this is very similar to buying a house. The amount of money that you put up to purchase the property, your down payment is your equity, and the rest of the money that you borrow is your debt. That's the loan from the bank. So when you're buying stock on margin, it's the same exact kind of concept. In this case, your down payment is the 5 grand, and then you're borrowing the other 5 grand from your broker. And so the way you calculate your equity is simply by taking the notional value, that's what NV stands for, and subtracting from that the loan amount. So in this case, $10,000 minus $5,000 is $5,000, of course, right? Because this is the starting amount of capital that you put up to hold that position. Now, what about your equity percentage, right? This one here is the actual dollar amount of equity that you have in the position, but this one here converts that number into a percentage. Is your equity 50% of the total value of the position? Is it 30%? Is it 60%? What is it? And as you can see here, the way you calculate this number is by taking the equity, the actual dollar amount, and dividing it by the notional value. So 5 grand divided by 10 grand and converting that into a percentage, that's 50%. And so your equity percentage is a very important number to calculate because that will very easily allow you to compare your equity to the maintenance margin. Now, as I explained earlier, your maintenance margin is basically the minimum amount of equity that you must have in your account at all times. Now, of course, for these examples, because our entire account is in this one position, that basically means for this one trade here, our equity needs to be at least 30%, specifically 30% of the notional value of the position. And right now, our equity percentage is 50%, well above the 30% minimum, right? So at the moment, we're totally fine. And so to convert this into an actual dollar amount, we just take 30% of the notional value of the current position, which right now is $10,000. So 10,000 times 0.3 is $3,000. So you can basically look at your equity in two ways. In terms of a dollar amount, right? We can compare the $3,000 minimum to the $5,000 we currently have in equity, or you can also compare the percentage, 50% compared to 30%. And so now, if you scroll over a bit more here, next up we have the margin excess. This is basically the additional amount of equity that you currently have over the minimum amount, basically the maintenance margin. That's what MM stands for. We simply take our current equity of $5,000 minus the maintenance margin of $3,000, and that gives us $2,000. So there we go. Again, we're totally fine as of right now. We currently have a very nice buffer of 2 grand. Now our profit on this position so far is going to be $0 because we just put it on. We just bought those shares. And that also means our percentage return on the trade so far is also 0%. And then finally, the notional value of the trade has not changed either. So the percentage change in NV is also 0%. So there we go. Now we are fully in the trade. We have all our numbers figured out. Everything is working together. And now we're going to see how all these numbers are going to move once the actual stock price moves. So if we come back to the left here, now let's say a few days pass by and ABC stock has gone up in price from $100 per share to $120 per share. So of course, that's a good thing, right? You bought the shares, you're bullish on the stock, and so far, this trade is working out nicely for you. So now that means the notional value of this position has gone up as well to $12,000. You still own the same 100 shares, but the share price has increased. So 100 times 120 is $12,000. Now your loan will always stay the same. You borrowed $5,000 to begin with, and as long as you hold on to the trade, your loan amount will always be that $5,000. And so that means our equity in the trade has increased as well. Basically, our ownership stake in this position has increased because the stock price has gone up and our debt on the position has remained the same. So taking 12,000 minus 5,000, that means our equity is 7 grand now. And next up, in terms of our equity percentage, this has also increased. And I am using some functions behind the scenes to calculate some of these numbers here. So what I can do is simply copy this cell and then paste it down below, and boom, there you go. That applies the same function down here of taking 7,000, our current equity in the position, and dividing it by the new notional value of this trade of 12,000, and that gives a new equity percentage of 58.33%. And real quick, let me go ahead and format this number here. There we go, much better. Very nice, things are definitely looking pretty good here so far. Next up with the maintenance margin, again, we just take 30% of the notional value of the trade, which is now $12,000, and that means our new maintenance margin level has increased slightly to $3,600. So yes, please do keep in mind that your maintenance margin is not a static number. This will change as the price or the value of your position changes too. And then now if you scroll back over to the right, there we go. But even though our maintenance margin has increased a bit, the margin excess is still going to be much greater now. So if we take our much greater equity position and subtract from it the slightly larger maintenance margin, we still get an excess of $3,400. And next up with our profit, so of course now that the price of ABC stock has moved, we are going to have some sort of profit or loss on the position. And this one is figured by taking the current notional value of the trade and subtracting from it the starting notional value of $10,000. So 12,000 minus 10,000 is, of course, coming back over here, $2,000. That's our profit so far, right? Because let's say at this point we sold those shares, got rid of the entire position, and doing so would bring in a cash amount of $12,000, right? And of that $12,000, 5,000 bucks has to be returned to our broker. We have to pay back our loan, and then the remaining $7,000 is what we keep. And of course, because we started out with $5,000, that means the excess $2,000 of that $7,000, that is our profit. And therefore, our percentage return, which is calculated by taking the profit divided by the starting account balance, that's what AB stands for. So $2,000 divided by $5,000, that's a percentage return of 40%. Very nice. And also let me go ahead and color code this number here. There we go. And then finally, we must also calculate the percentage change in the notional value. And this one's important so that we can see how much the margin is magnifying our profits or losses. And so far, the notional value has changed from $10,000 to $12,000, right? And so that means this last column here is just going to be taking that difference and converting it into a percentage, in which case that's going to be a percentage change of 20%. So there we go. You can already see the difference in terms of the magnification of your actual return compared to the change of the position itself. The value of that long stock position only changed by 20%, but your return on the trade was 40%, 2 times that. And that's the power of trading with margin. It magnifies your profits or your losses. So with that said, we'll come back over to the left and walk through a couple more examples, and I'll do so a bit more quickly here. So once again, a few more days pass by, but now something happens with the company and the stock price gets killed as a result. So now the price has fallen from 120 bucks per share down to only 80 bucks per share. So that means the notional value on the trade has fallen from 12 grand down to only $8,000. Your loan amount, of course, stays the same at 5 grand, and your equity, taking the difference of the notional value and your loan, has also fallen down to $3,000. And then if we convert that into percentage terms, that means our equity percentage has fallen down to 37.5%. So now at this point, we're getting pretty darn close to the minimum equity percentage of 30%, right? We're still fine for the time being, but of course, the stock price cannot drop that much further. So now to figure out the actual dollar amount of your maintenance margin, of course, because the notional value of the trade has fallen, your maintenance margin has fallen a little bit as well too, down to 2,400 bucks. So at this point, like I was saying earlier, you can also compare the actual dollar amount of your equity to the dollar amount of maintenance margin. So the difference here is only 600 bucks, which of course, if we come over to the next column, that's what the margin excess is, right? So applying that same math, that means again, the current margin excess is only 600 bucks. Next up with our profit, now that the notional value of the trade has fallen below the starting point of $10,000, this means we currently have an overall loss on the trade. So if we take the current value of 8,000 bucks and subtract from it the starting value of $10,000, that means our current loss on the position amounts to minus $2,000. And let me go ahead and color code this one as well. Okay, and then next, if we convert that loss amount into a percentage, taking 2,000 bucks, dividing it by our starting capital of 5,000, right? Again, we're trying to figure out the return on just our capital, not the whole position together, because of course, half that capital is not even our money. So our personal return is minus $2,000 divided by $5,000. So that means now we're down by 40%. And then finally, the percentage change in notional value of the trade from the starting point. Well, a change from $10,000 down to $8,000 is only a drop of minus 20%. So once again, trading on margin has magnified our loss in the situation by a factor of 2. And that's because you always have to repay your broker the full amount of money that you borrowed. So that's why the full outcome of the trade, the full profit or the full loss, is always compared to your starting capital amount, what you put into the trade, that $5,000. And then finally, for our last example here, let's say your luck continues to run out and a couple more days pass by and the stock price has fallen even further, down from 80 bucks per share to 60 bucks per share. So that means the notional value of the whole trade has fallen further, down to $6,000. Once again, your loan amount stays the same at 5 grand, and your equity stake in the trade has also fallen down to only $1,000. Next, with your equity percentage, this has also dropped down to 16.67%. So now you are well below the minimum 30% required, at least for TD Ameritrade. And then to convert the maintenance margin into a dollar amount, that's going to be equal to $1,800. So your current equity is $1,000, but you're required to have an equity stake of at least $1,800. So now if you scroll back over here a bit, that means your margin excess is going to be minus $800. And so now at this point here, you would receive a margin call from your broker. And as a result, you would either have to deposit more capital into your account and bring your total equity stake above that 30% minimum, or you can also liquidate existing positions to free up capital and also bring your equity back up to where it needs to be. And of course, if you fail to do this on your own before the time expires that your broker gave you to fix this problem, then your broker now has the right to go into your account and forcibly liquidate your positions until your equity is now at a satisfactory level. And they may also charge you some hefty fees for doing so as well. So now moving on, our profit on the trade so far, again, if we take the current notional value of $6,000 and subtract from it the starting value of $10,000, that means now we've lost $4,000. $4,000, there we go. And so then in percentage terms, taking the $4,000, dividing it by our starting capital of $5,000, that means now we've lost 80% of our capital. Even though, of course, the actual change, the percentage change in the position itself has only fallen by 40%. So once again, because you are borrowing half the amount of capital needed to hold that trade, that's why your realized return on this position is always going to be double the actual percentage change of the position itself. So that also means if you were to borrow less money, then the magnification of your return would also be smaller. And basically because you can only ever borrow a maximum of 50% of the full capital needed, that means the maximum magnification of your returns will always be 2x, 2 times. And that really is a double-edged sword, right? Of course, it's very nice to have magnified positive returns, but with the way things work in financial markets, you're never going to be able to have that kind of boost without taking on more and more risk. So please be careful when you are trading on margin. It can definitely be a very powerful tool if you know how to manage your risk, manage your trades correctly. But if you don't, you could find yourself in some really hot water extremely, extremely quickly. So again, please be careful. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.